Well, we've been looking for an intermediate pullback for the couple weeks, and boy, howdy, did we ever get one this week. So finally, it's over. We survived. Now what? Now that we pulled back, probably more than anybody thought we would in such a short amount of time. What do we expect to see going forward? So that's what I'm going to break down. What do we expect next week? What do we expect after that? From the technical patterns that developed over the course of this week. So I'm going to break all that down, as well as another way to trade and find trades in an environment like this where it's such a dramatic move, and how we can be able to take advantage of it. So let's go ahead and get started. Today is Friday, October the 12th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you tuning in for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Click that Market Scholars logo right here. Then click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells me two things. Number one, you liked the video tonight. You got something out of it. Number two, you want me to do it again on Monday. Really quick and easy way to give us feedback. There, comment. I want to see comments today. I want to see what you're thinking, what you're seeing after this crazy week. Scroll down to the bottom of this YouTube page to comment down below. Also, join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen that includes a list of stocks that are showing overbought or oversold clusters on the market forecast indicator. I believe yesterday Brandon told me there was 174 stocks on that list. So join that list up there. Click that link to join so that you can get those watch lists in your email day after day. And also follow me on Twitter for more content I put out there like this throughout the day. And join our Market Outlook community that we put together on Facebook. All right, let's take a look at the S&P 500 with the market forecast indicator first. And you'll see that we have a long lower shadow today with that late rally into the close up to 2767 by the time it was all said and done. It actually kept us from having a second straight cluster. We don't. It doesn't happen very often that we get two straight clusters, oversold clusters on the S&P 500. If you look here, we got a couple right here in November. That was the last time. That was the last time we got one cluster, much less two, and we got a couple back to back. You can see right there. And then we had a period where we got a few clusters while the S&P was trading below the 200-day moving average, and it's, you had the 50-day also trading below the 200-day. And then over here, another period in October of 2014, we had a couple back-to-back clusters there. And you can see we had a good rally off of that low point. We had a good rally off of this low point. And like I said today, the opportunity, you notice we didn't get a cluster. It was so fast. Excuse me. It was so fast on that pullback in February that we came off and really only barely dipped our toe below the water. And then again here. So you can even see, we rarely even get the intermediate line below 20. Here, like I said, we had this period where we were below the 200-day moving average, where you did get quite a bit of time below 20. But rarely will we ever get down and stay down below 20 on the intermediate line, especially with market sentiment as high as it is. Like February was a similar scenario where we brought the intermediate line down. We were already pretty darn high on the market sentiment. Now, this period of time here is not so bullish in the markets. We are heading into a seasonally bullish time of year, so the recovery off that February low was kind of hindered by seasonality into the spring, and now the seasonality actually favors more of a recovery. So you wonder, will that be able to help us keep market sentiment up a little bit higher? Now, market sentiment, we've had two runs, we've had two intermediate runs during this current long-term run. It started back here on May 14th. We didn't quite get the 6 months. The typical time frame for a long-term market sentiment run is 6 to 9 months. So we didn't quite get there. We got the 5 months, but we're also not done yet either. Market sentiment's still above 50, so it hasn't pulled back quite yet. Short-term sentiment is bouncing, and that's going to be the key to determine when and if we do get a new bullish intermediate rally, because it will occur at some point in time. The intermediate line will turn up. It doesn't stay down forever. It doesn't stay up forever. It will bounce up. The question is when, and that near-term line and how far down it is when it bounces and where it peaks will be the key. You can see on some of these others, when we do get down, getting up above 80 on that next rally, that's the key to things ending. You notice over here, the near-term line did get up above 80 and it was able to halt. We were down for quite a bit below 50. We kind of had an up and down right there, a little bit of a bullish divergence from this low to this low, higher lows in the near-term line, lower lows here, and then we bounce off of that with a strong move. So that's the kind of thing we need to get the intermediate line rolling up again. Now here we had some good bullishness. We also had some pretty deep bearishness, and eventually we got too bearish, and that's what brought the intermediate line down again. We went down to lower near-term lows, but again, once it fell, we got to bounce up higher all the way up into the upper reversal zone. That helped set the low point, and we never did get a dip on the blue line below 20 again, not until way over here. So that's kind of what we need to see right now, is a good bounce on the blue line, and that will tell us the intermediate line is going to start working its way higher. Now, I don't think necessarily we're going to go up straight up Monday or Tuesday. There's going to be, the volatility index is really high, relatively speaking, even after the late day pullback on volatility. So there's still going to be some ups and downs. There's going to be some big ups and downs, most likely, as we head into now the heart of earnings season. But that's going to be what we watch, is that blue line to see. It's got to get above 50. That gives us a new high. The last near-term high point was obviously right there. Had to get to back to us a 1 year chart here. There's the last near-term high. We're obviously not going to get up above that high in the next near-term run. So we're not going to get a bullish near-term high point, but at least getting it above 80 will help solidify this low point. And that's a Harami pattern, a little small body inside of a larger body the previous day, and of course a long lower shadow. You can see when you get long lower shadows, you just look, it doesn't have to be, huge. As you can see, when you get the longer lower shadows anywhere, they tend to be bullish. It's a good sign for coming off of this sharp extreme low point we've had the last couple of days. Let's take a look at these other indexes. The Dow Jones Industrial Average, you can see same Harami pattern developing there, same pattern on the market forecast. Its intermediate posture is down. You can see the NASDAQ Composite had a nice good bullish close. In fact, we closed above that high point. There's the high at 74.93. We got to 74.96. So multiple clusters there. First one in the past year. And then the Russell 2000 finished with the cluster today, but it finally, the last few days, these are all bearish candles closing at the low, getting a doji pattern at the end of an extended run with a relatively longer lower shadow compared to what we've seen. That's a good sign too. That can be a reversal sign, because if you get a bullish candle on Monday that gets to the halfway point of this candle or higher, then that's what's called a morning star candlestick pattern. And again, the bigger the range is, that's a really neutral. That means the bulls and the bears really duked it out today in the Russell, and they finished right at the starting point. So nobody really gained ground, but remember, the bears had been gaining ground for the last couple of weeks. So the bulls were able to step in and hold this level as of right now. And, of course, if you try to see some Fibonacci areas, we have a Fibonacci area at that low point here. It's not an intermediate low point, but there is a near-term low point at that level, right at that Fibonacci retracement. It was able to hold the ground there so far and potentially bounce up coming into the next week. Now remember, there's going to be some ups and downs next week, but ideally you would expect it to bounce up. Let's come really quickly to the weekly charts on the market forecast. There's the, again, lower shadow that you see on the weekly charts, a good sign, especially holding that moving average. You can see even the momentum in the near-term line avoided really extreme lows. Here's the weekly. Let's go to weekly chart on the Dow Jones Industrial Average. Same thing, avoiding extremes on that momentum line. The NASDAQ Composite on the weekly chart, same pattern, bearish posture, but avoiding strong oversold levels on the weekly. The Russell 2000, which is higher beta, it did come down. And again, getting it down to these lows usually leads to a bounce on the next period, which happens to be a weekly period. So, we expect ups and downs throughout next week, but eventually, according to these patterns, of course, anything can happen, but according to these patterns, we expect it to be a bullish bounce coming out of next week. All right, before we look at some other charts, I wanted to remind you that if you're watching this on our blog on marketscholars.com, to click a few things for us. Click this like right there. That opens up your Twitter window where you can click that like button. Click this Facebook image. That takes you to your Facebook account where you can also click on the like button there. And then click on this like button. Those 3 clicks tell me, David, we liked the video today. Let's do it again on Monday. Really quick and easy. You can do that right now while you're watching. Also share this with others. If you feel like it's valuable to you, share it with other people through your networks, either on Facebook or on LinkedIn. A lot of times if you share something on LinkedIn, it gets to people that you're connected with, especially some of your colleagues that might be interested in the same type of content that you're interested in. Now, when you look at the weekly chart, you can see how it compares to March and February. And again, getting a big drop like this when you're above the 200-day moving average, especially as far as we were, is a much better thing than getting a drop like that when you're below the 200-day or getting below the 200 days. So, there's a lot of opportunities here. Here's November 16. There's these lows here. We had this. There's that October 14th I referenced before. When we are this far up above and we get a sharp, fast move down to the moving average, it tends to hold. Now, when you're close, when the MACD here is low and you get a big sharp break of support, different story. It has a good chance of holding. But even on the Russell 2000 where it's really dipped below, and if you go a little bit longer term, you can see we've had this before. This is actually, we probably won't get a week like this back in November 16 because that was the presidential election. We don't have anything this week that would cause us to bounce back up that sharply after having closed below the 200, and here we actually held the 200 before bouncing. But here is a week where we did drop below it and we came back up by a few weeks later and were able to continue higher before we got more of an extended pullback. That's more of the expectations what I'm looking for here going forward. We might not get back above the 200 next week, but if we bounce something similar to that, see some lots of highs and lows there in October 14, but eventually a couple weeks later we got back up above it and things were much better, and we were actually a lot closer to the MACD. MACD was actually closer to 0 back here than we are even now. So the expectation, because we are so far away heading into this sell-off, that we'll bounce off of this, and most likely won't be like this 1 week big sharp bounce like we see some of these other weeks. It will most likely be something like here where it might take a week or two, especially that first week of a lot of ups and down volatility because of how far below the 200-day we got, and then continuing higher into the seasonally bullish time of year. Remember, this was October as well. This was the week of October the 6th, and we are right now in the week of October the 8th. So very, very similar time frame, and we headed in, we were bullish heading into the end of the year, and that's the seasonally expected pattern. And that's what we can expect right now. Of course, when you look at the 3 green arrows, it's a 3 red arrow, and we're not going to get 3. We're not going to get 3 green arrows. Like the arrow that we'll get when we get this far down like this, the arrow you get first is usually the stochastics. There's February. You see how we got the stochastics pretty quick. And the MACD will take a lot longer, and then obviously we're way below the moving average. Here's what it looks like on 3 when you separate out those lines down there. We'll cross above that moving average a lot quicker on the stochastics than we will on the MACD. That's what gives you the green arrow on the histogram, is when the blue line crosses above the orange line. The blue line is really, really low, and as I've shown you before, when the MACD gets really low, it's hard to extend those losses from these levels. Now, we can definitely diverge, right? We can get to slightly lower lows with higher low in the MACD. That can happen in the next week or two, so it's something to keep an eye out for. But in terms of like today, tomorrow, the day after, Monday or Tuesday, to continue the bloodbath, it can happen because anything can happen, but the odds are a lot lower because of how low this MACD already is, which basically represents how low the 8-day is compared to the 17-day. And even then, if I were to change the MACD here down at the bottom and change it to look at how far down we are below the 30-day moving average just in terms of price. There we go. Then you can see we're also pretty far down there. Again, similar to this level, that second move lowered. That's how far down we are below the 30-day on the MACD. So typically a sign that that the low is in the process of being set right now. All right, let's take a look at the intraday chart. Obviously, we didn't get a higher high, but we also didn't get a lower low today. So an inside day, another good sign from a reversal standpoint. Obviously, getting above this 275.5 will be a good sign for the reversal to take hold. But you can see that was last week's range, right? And now the 4-week range has moved out to a 23 point move. You know, just to kind of give you an idea, if I were to do the same thing, if I were to go out to that end of, after that February move, it was this February 9th through the 12th. If I were to go out here and say, okay, let's go from the 9th, and then we'll go, let's see, it was in January, it was 1, 2, 3, 4 weeks right here. So we'll start on the 12th. That's our 4-week period, and we'll keep it on an hourly chart. So this is what it looked like then. That's the pullback. That was the bounce into the close. That was the 4-week range, I believe. Let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, so there's your 4-week range there, and we were at 30 points, right, because of that last kind of push down, 30-point range. We were, 286 down here to 258. Yeah, we were at a 26, 28-point range at that point. And again, to compare it to now, that's about, we're at 293, 294. So we have about a 24-point range right now at a higher level too. So this isn't as big of a sell-off, as big as a range as it was in February, but still pretty large. And you can see how we're, we might push down a little bit lower throughout the week. Next week, if we get some highs and lows, they're going to be big highs and lows. So we might push up and down here, and in the process of going down, might push that low down a little bit lower. But this is a wide range, and again, another good sign of a low being set. Now, as we move up, look for some resistance in the short term. Those initial rallies will most likely not take us up here. It will most likely take us up towards some resistance, and then we'll come back down. And that's where we say, okay, when it comes back down, how far down will it go? Does it hold that low point again? Does it go lower? If it goes lower, does it set up a divergence? Those are the kind of things you watch for after that first surge. You'll get a first surge that will sucker a lot of people in, and then it will be sold off, right? As people, who couldn't sell off here, now say, okay, if we get back to this area, now they'll sell it, and they'll find a lot of buyers buying it up. So where does it pull off to? How strong will that sell-off, that second sell-off be? That's going to be the biggest question in terms of when this how this next intermediate run is going to take shape and take form. If we look at the volume today, again, it was high. It wasn't as high, so we didn't get that 3 standard deviations. It was down to 183 million. And you look at it here on the 3 green arrow chart, pull up SPY. There's your volume. So it was more than 1.5 times the average, but not that 3 standard deviation. The volume on the futures contracts, if you see the futures contracts here, you can see that yesterday we were up to 3.5 million. We kind of exceeded that. Today we came back down. So kind of another good sign there that the volume is not remaining excessive. Let's go back to SPY. So more than 1.5 times, 183 million. The trading range today, no gap, so the trading range came way down, half of what it was these last couple of days, 4.72. So you go to the this chart and put that in context. 4.72 points now is at the top end of this 52-week range, so right there. That's where today's range was. 183 million still is off the charts, so very extreme, still pulling this up. you can see this got up above 1%. So we had a couple really big sharp moves that were higher than 1% and brought the average up that quickly, which means, again, these lines have pulled up enough that if and when they fall over, and just for some context here, let's go back on this daily chart here and go back to this October 14 area right there. So you can see we did get up above 1%. We got up, the volume bounced up, and the volume was higher in these areas before this really abnormal low point. And then there's your normal ATR. We're actually higher now on the ATR, even if we're not on a relative basis higher, which is the blue line. But the point is, we're setting up. Expect more volatility next week for these lines to continue to go higher, and the higher they get to these levels, the opportunity now for them to roll over, which is typically a bullish. And whenever they roll over, stock prices usually rise higher. And then finally, we'll look at the volatility index. Good pullback at the end of the day, heading into the weekend. It's still high though. It's still up above 1.05, so it's still at an extreme level. But not as high as it had been. We closed yesterday at 1.15. It was rare for us to get closes that high, and now we're already pulling back. And as it pulls back, you can expect, as we're up above 1, expect some ups and downs. But when we get back down below 1, then that's our setting for more of an extended intermediate run to the upside. All right, so to summarize, we had a crazy sell-off. And we had been expecting an intermediate pullback for a while. There was a lot of signs out there. The extent of the pullback was larger than anybody had anticipated. Otherwise, people would. Now, of course, there are people who have been looking for this kind of pullback every day for like the last couple of years. So, they'll obviously say that this is exactly what they were looking for, just a couple of years maybe too late. But if people had been expecting the markets to pull back this much over the last couple of days, the markets would have been pricing it in. So nobody really expected this extent of one, but the more extreme it is, the more likely it is to end quickly and for a new intermediate run to begin and to go forward, especially with the seasonally. In February, we bounced off a February low into a seasonal time of year where we usually don't get a lot of strength. Here, this is the most bullish time of year, so we have the environment set up for a bounce to occur. And again, the more extreme the selling was, definitely going to hurt your short-term trades. But in terms of new intermediate-term trend-type trades, the more extreme it was, the better, because it ends quicker. The selling ends quicker. Instead of dragging out over a couple of weeks maybe, the selling ended in a couple of days. There'll be some volatility considering how high the VIX is, but an opportunity for new trends to occur out of this, as we were looking for anyway, just obviously not this far down. So that's the summary of what I'm seeing. I expect a lot of volatility in the next week, ups and downs. I do expect ultimately to be up at the end of next week, and then how long it takes to get back up above the 200-day might take a couple of weeks on the Russell, but on the S&P 500 we're already getting back up above it. And eventually for volatility to get back down to more reasonable levels. So what do you think about that? Do you agree with that? Do you disagree with that? Click that poll question popping out in the top right, or click the link popping out in the top right corner of your screen. Then open that up poll. Click either one of those answers. And if you click on disagree, scroll down to the bottom in the comments section. Another day, I would love to see your comments. What are you thinking? What do you think about the market? What are you expecting going forward? What are you seeing that would suggest otherwise from what we've talked about today? Love to hear your thoughts. All right, now let's turn our attention to what's driving the price action today. And of course, we all know what's been driving the price action. Interesting to see, but this is the 2-week period. So you can see stocks have been falling for most of this 2-week period. During this time, initially oil had started up pretty strong, as well as agricultural commodities. They stayed strong despite the trade tariff, right? But oil had pulled back along with all these other risk asset classes. And then everything bounced up today. You can see over here on the left, emerging markets, which had been the weakest performer before today, doing well. Growth stocks bouncing up, S&P 500 bouncing up, agricultural commodities still staying strong, all outpacing ACWI. On the other end of the spectrum, gold, which has been doing well, coming down, and bonds coming down. So As much of a risk off day it was yesterday, it was a risk on day today. And now, as we bounce off of these lows, as we set the bottom and we bounce off these lows, remember, it's not going to be a V like one day down, next day up, and then never down again. There's going to be ups and downs, most likely next week. But as we come up initially, you'll most likely be led higher by growth, and small cap stocks can do better, even though they weren't up today. You would expect them to do better. Emerging markets did well. Those are the asset class. Technology. We'll look at sectors here in just a minute. You expect those types of high beta, high growth to lead us up in the initial surge, but the rotation is taking place towards dividend stocks, towards value stocks, towards large cap stocks. Expect those are the type of asset classes to gain. Expect gold to start to do better. Gold had a little bit of a breakout move here this week. If I take a look at the market forecast chart for the gold futures contract, you can see its intermediate line turn up above 50. We had broke above all these highs, so a bunch of near-term highs in here. Very good sign. A little bit of a return move today, but a very good sign for gold. And you can see, of course, crude oil pulling back like everything else, not pulling back as deeply as everything else. You can see pulling back down to some Fibonacci support areas, 50% Fibonacci support, with that 62% lining up with this area right here. So you had a little bit of a pullback in that, and again, you'd expect those to continue higher coming out of any bounce, with more weakness continuing here in the dollar, knowing the cycle, right? The cycle of commodity prices and yields and inflation expectations. Now, one of the things that was on the calendar here, this one over here, this week was inflation, and you notice on a year-over-year basis, CPI is moderating. It's been relatively high. It's starting to moderate. That's on a hot headline basis. The core level pulling back a little bit less, but still pulling back from higher levels. The PPI on Wednesday, similar pullbacks you can see on a year-over-year basis. And then you have import and export prices, another measure of inflation, both pulling back. The import and export prices coming down. So inflation expectations are moderating. That hasn't, up until today, that hadn't helped, or before today, it helped bring these rate hike odds down back below 50%, but now they're back up above 50%. So a week ago, we've tipped down a little bit in terms of rate hike odds for March, right? Because December is still very high. It's still up, almost 80%. It's actually up higher than it was a week ago. A little bit lower, a smidgen lower when you combine the two, this level here. But still at 80% odds, still a decent chance that we'll get that rate hike in December as expected. The March is the question mark, and we started the week off at 55%, and we came down to 53%. So we're still above 50-50. We'll see as that continues. If the inflation continues to moderate, with all the political pressure that's on the Fed right now, again, it's just purely rhetorical pressure coming through the headlines. But they would be able to respond to any criticism of their policies if inflation moderates, without it looking like they are simply just doing whatever they're told to do for political reasons. So we'll see if that inflation pressures over the next month or two continue to moderate, and what that does to the odds for that first rate hike to occur in March. Of course, that would help keep rate yields down. If the rate hike odds start to fall, they don't have to drop rates, but if they hold off on raising them, that would also not bring yields down per se, but it would help moderate their rise. A lot of their rise coming from this higher inflation expectations, as well as on the short term higher rate hike odds. Coming back to this chart here. So where did we go? Over here on the asset class comparison. If I were to jump out, just to kind of give you an idea of the extent of the pullback, over the last 6 months, the S&P is still the best performing asset class. one of the best, right? It's down, it's pulled back below the dollar, and crude oil is still up. But you can see, I mean, this should put into context the gains that we've had over the past 6 months and what this drop has done to those gains. You can see gold is still down here. Emerging, international stocks really lagging behind. When risk appetite bounces, again, expect international stocks to be able to start to recover some of that loss. And you can see IWM is basically giving up all of its gains over the last 6 months. But just until a couple weeks ago, it was the best performing asset class before crude oil took off. And you can see a little bit of a crude oil taking off and putting pressure on stocks because of that rise. Again, rising yields and rising commodity prices are both together a sign of rising inflation expectations, which now the actual inflation data so far are showing that the rise in inflation might be moderating itself too, and that will help put a cap on those expectations going forward. All right, as I mentioned before, as we get that bounce, one thing I wanted to show you in this other segment is actually right here. This is another reason, and again, this is purely statistical, so take it for what it's worth. But here's a couple of things that were happening today. A big jump in the VIX that happened to get it above its Bollinger Band, but closing below 25. Obviously, the S&P is down for the week, but still above major moving averages. This would be a 50-week moving average, so 250-day. You can see that when that scenario occurs, so basically kind of what I've been telling you, big drop, quick drop, but the market's still up above these major long-term support, moving averages instead of being below it, right? So when that occurs, you can see the odds for bounces really rise up. In fact, 29 out of 30 times that scenario has played out, 29 out of 30 times it was higher 5 weeks later. So again, the odds for a bottom being set because it was so big, the drop was so big, so fast, sets up the odds for a bottom occurring a lot higher instead of having to grind out a long extended bearish run. Those tend to occur after the price and the 50-day moving average both drop below that 200-day moving average. As I also mentioned, when we do bounce, you'll probably get technology and discretionary leading the way higher. I don't expect that to be a long-term thing. They typically will lead on a quick move higher to the upside off the lows. And then if commodities stay bullish and the dollar stays bearish, expect energy and materials to take over the leadership along with industrials. All three of those lagging behind right now. And your biggest winners would be the higher beta, higher growth areas that have been sold off quite a bit, right? They had been, here's technology and discretionary. They were the biggest ones that were sold off. And communications, the dark green, those are the three biggest losers. So not surprising they'd be your three biggest winners on any bounce. All right, one thing to look for when you're looking for trades in an environment like this is to see, okay, what was doing okay before this sell-off, right? You can see a stock like Amgen, for example, was on an upward trend. It was trending higher, had broken out to new all-time highs. It was pulling back during this, the start of this intermediate pullback, but it had pulled down the support. It was holding that support level and was looking to bounce. Things were fine until these last 2 days, last 3 days, and you had boom, boom, and then today bouncing up with everything else. And you can see, so when you look for something like that, you say, okay, well, it got caught up. It's gone from 200, 205 all the way down to 193. It got caught up in a lot of that selling where previously it was nice and it was trending nice and higher. Slow as grinding, but it was trending higher. And then during the pullback, it had pulled down to some important major support levels. So we can say, okay, well, we can, like the theme of the week is to sell puts, right? High volatility, big pullbacks. We can sell puts. This is an expensive stock. So just selling that 30 delta put would take, $3,000 on buying power. So you get a little bit more than 10% return. If you want to reduce your buying power, you can buy the 185 put. It reduces your return, but also dramatically reduces the buying power. So you get a much higher, a little bit. Well, you go from over 10% to about 30% return on risk. Depending upon where you get filled in, right? That's a little bit wide spread. So it's expensive stocks, you tend to get wider spreads. So even there, you still get a pretty decent return on risk. about 30%, a little bit more than 30%. So that's one way to take it. It's like selling a put, but with a lot less capital, a higher percentage return. Now I can lose money quicker, right? That selling puts moderates the losses because it takes a lot more capital to get into the trade. But you can see for us to get to maximum loss, we'd have to drop below this 185, where there's a significant volume between 185 and 190. So a lot of support in this area to help hold you above, much less a bunch of touches in that area. So it would take most likely take the market falling through the floor and not producing this bottom for this to do it. Remember, again, considering how bullish and how solid the stock was prior to this extreme selling the past couple of days. All right, so that wraps us up for today. As always, thank you very much for watching tonight. It's a crazy week. I have a feeling we'll have some ups and downs. We'll have a crazy week next week too. In terms of whether or not we'll get a big drop by the end of the week, I think the odds of that are lower. But regardless, there's going to be a lot of ups and downs. There's going to be days where we feel like the world's going to end next week. There's going to be days where we feel like let's go, we're right back at it, and then the next day will change. So expect that next week. I do ultimately expect, with all the technical factors that we looked at today, that will form a bottom somewhere around this area and get going again into a good seasonal time of year. As always, remember to subscribe to our YouTube channel. Click that thumbs up icon down there and comment. Want to see what you think. Also remember to follow me on Twitter for more content like this. And finally, join our Market Scholars community on our website. You can do that for free. Also remember to join our Market Outlook community on Facebook. Have a great rest of your weekend, everybody. We'll see you all on Monday.